Hello, this is Conrad Invest. Today I'll be talking about how exactly you can value a stock. So when it comes to valuing a stock, there are multiple different ways you can go about doing it. You can use the price to earnings, you can use price to earnings to growth, you can use price to book. Some people use EPS growth as well, and then they project out how much of earnings you will keep. And then the most fundamental one that Warren Buffett does is he uses a discounted cash flow analysis. So a discounted cash flow analysis, to put it simply, is just to determine how much cash a company can generate across the lifespan of the company. So in a discounted cash flow analysis, there are a few things that you need to take note of. So number one is the growth of the cash flow. Number two is something called a discount rate. So this is how you can think about discount rate. So if let's say you collect $10 today versus if you collect $10 1 year later, which one will be worth more? It will be the $10 today because you can use the $10 and then you can buy fixed income assets, you can buy cash flow generating assets like stocks that will give you returns. So to put it simply, cash that you can get back in the future is worth lesser than cash that you can keep today. So what you should be always inputting in your discounted cash flow analysis is your discount rate. And for your discount rate, normally it will be the S&P returns, which is around 10%. So the next thing that you need to think about is the growth of the free cash flow. So when it comes to the growth of the free cash flow, normally for mature companies, it will mirror your growth rate of your net income. Or more specifically, it will be your operating cash flow minus your capex. So put in a growth rate that is suitable for the company and compare it with the industry average as well as the historical growth averages. So let's do a quick example to show you what I mean. Okay, so let's try and value this company over here. This company is MSCI. So this company is one of the highly predictable indices in the world. You see MSCI Global Index and all that. So for example, over here, MSCI has around 1.43 billion worth of free cash flow in the past 12 months. So let's put 1.43 billion, it'll be something like this. And then next one, so this is your weighted average cost of capital or your discount rate. So for this one, you can either put it at 10% or 9%, or you can even increase it higher if you think the company is not very predictable. But for me, MSCI is a high quality business, it's quite predictable, so I decided to put it at 9% instead. Next is to forecast the growth. So as you can see for MSCI over here, over the past 10 years, the free cash flow grew at around 18%, past 5 years 16%, past 1 year 24%. But I think for MSCI, because the growth in the net income is slowing, I think the free cash flow will slow as well to around a 13% and a 10% in the next 5 years after the first 5 years. And as you can see over here, MSCI is currently trading at around fair value. So remember to input in your shares outstanding as well. So MSCI over here has around 78 million worth of shares outstanding. So it will be 78,000 over here. All these are calculated and rounded off to the nearest thousand. So as you can see over here, MSCI is trading at around fair value now, but I want a bigger discount for MSCI, and so maybe I'll be entering at around a 15 to 20% discount rate, which is around $500.